Most people enter the stock market thinking it's a place to make quick money. They see prices moving up and down, hear stories of people doubling their money, and they jump in with excitement. But the biggest lesson serious investors learn is that the market is not a casino, and if you treat it like one, it will punish you like one. The first important idea to understand is the difference between investing and speculating. Investing means you carefully study what you're buying. You look at the company, its profits, its stability, its future potential, and you make a decision based on logic. Speculating is different. That's when you buy something just because it's going up, or because everyone else is buying it, or because you feel it will rise. The problem is, feelings don't protect your money. Analysis does. Another powerful idea is to think of the market like a person with extreme mood swings. Imagine you own part of a business, and every single day someone comes to you offering to buy your share or sell you theirs. Some days this person is overly excited and offers a very high price. Other days they are depressed and offer a very low price. The key is this: you don't have to react every time they speak. You can ignore them. The market behaves the same way. Prices move based on fear and greed, not always on real value. Intelligent investors don't follow the crowd's emotions, they use them. When others are fearful and prices fall, opportunities often appear. When everyone is greedy and prices are unrealistic, that's the time to be careful. One of the most important principles in smart investing is protection. Before thinking about profits, think about safety. This is where the idea of buying with a margin of safety comes in. It simply means buying something for less than what it is truly worth. If you believe a company's real value is much higher than its current price, you create a cushion for yourself. Even if things don't go perfectly, you reduce your risk of major loss. But if you buy something at a very high price just because it's popular, you leave no room for mistakes. And in markets, mistakes are normal. Another important concept is understanding what type of investor you are. Some people prefer simplicity. They don't want to constantly study financial reports or track daily price movements. They choose stable investments, diversify their money, and focus on the long term. Others enjoy deeper research and actively look for undervalued opportunities. Both approaches can work. The real mistake is acting careless while taking big risks. If you don't want to do deep research, then you shouldn't take aggressive positions. More than numbers, successful investing is about emotional control. Markets will test your patience. Prices will fall when you feel confident. Prices will rise when you feel uncertain. The biggest enemy is not the market, it's your own reaction to it. When prices crash, most people panic and sell. When prices rise quickly, most people chase and buy at the top. Discipline is what separates long-term winners from short-term gamblers. In the end, the real goal of investing is not to get rich quickly. It is to build wealth steadily while protecting what you already have. It requires patience, rational thinking, and the ability to stay calm when others are emotional. The market rewards those who think independently and act logically. If you remember one thing from all of this, let it be this: focus on value, protect your downside, ignore emotional noise, and think long term. That mindset alone can completely change your financial future.